Most people who buy their first call option think they've bought a lottery ticket. Cheap price, huge upside, and if the stock rips, you're rich. That story is emotionally satisfying and financially wrong. Before we go further, one thing, this is educational commentary, not personalized financial advice. I'm going to show you a mental model, not tell you what to buy. Here's why this matters right now. Retail options volume has exploded, and a huge slice of it is short-dated calls bought by people who have never once drawn what they actually own. They know the payoff feels like a jackpot. They have no idea what the shape of that payoff really is, and the shape is everything. So let's build the real thing from scratch. Forget formulas. A call option is a contract that gives you the right but not the obligation to buy 100 shares of a stock at a fixed price, the strike, before it expires. You pay a premium for that right. That's the whole object. One right, one price, one deadline. Now the part nobody draws. Say a stock trades at 100. You buy a call with a strike of 100 that expires in a month, and it costs you $5 per share, $500 for the contract. Let's ask a simple question. At expiration, for every possible stock price, how much money did you make or lose? Plot that, and you get the payoff diagram. Below the strike, the picture is brutally simple. If the stock closes at 100 or 95 or 80 or 0, your call is worthless. You lose the same $500 every time. That's a flat line at minus 500. Notice what that means. A stock can drop 20% and it changes nothing about your loss. You already lost the maximum the moment you paid. Above the strike, the line finally turns up. At 105, the call is worth $5, you break even. At 110, it's worth 10, so you doubled. At 120, you've made 300%. The payoff climbs at 45 degrees, 1-for-1 with the stock forever. So the real shape is a hockey stick, flat on the left, a hard kink at the strike, a straight climb to the right. Here's the aha. A lottery ticket pays off at exactly one number. A call pays off across an entire range, and it's priced against that whole range. When you paid $5, the market wasn't guessing moon or zero. It was weighing every outcome, the small moves, the flat closes, the crashes, the rips, and charging you the average. You didn't buy a jackpot. You bought a probability-weighted slope. That's why the durable handle here is, you don't buy the moon, you buy the slope. The moon is 1 point on a line the market has already priced, and that reframes the losing trade completely. When your call expires worthless, it didn't fail. It landed in the fat, flat part of the payoff, the part that was always the most likely outcome. Now the piece that punishes lottery ticket thinkers, time. That premium isn't static. A big chunk of it is time value, and time value decays every single day, faster as expiration approaches. So the flat part of your payoff isn't really flat while you hold it, it's a slow leak. If the stock sits still, you don't break even, you bleed. The ticket that could still win is quietly getting cheaper in your hands. Put those together and you can finally price a trade like a professional instead of a gambler. Suppose the option market is pricing an expected move of about 8% over the life of your call, as of the day you buy it. Your break-even needs the stock up 5% just to cover premium. That means a big part of the priced-in move is spent paying for the contract before you make a cent. That's not bad luck. That's the math you agreed to. Let's kill the most common myth directly. Calls are cheap. A $5 call on a $100 stock feels cheap next to buying the shares, but per unit of risk, you're paying for leverage and for time, and you can lose 100% of it while the stock barely moves. The share buyer down 20% still owns something. The call buyer down 20% owns nothing. Cheap price, expensive risk. So what does a disciplined trader actually do with this? First, they draw the payoff before they click buy, strike, premium, break-even, max loss, so the trade holds no surprises. Second, they size it as a total loss. If the whole premium going to zero would hurt your account, the position is too big, full stop. The flat line at max loss is not a worst case, it's the base case. Third, they have a thesis the payoff can express, not just it goes up, but how far and by when checked against the move the market is already pricing. If your target is inside what's priced in, you're paying full freight for a move that's expected, there's little edge there. The edge, when it exists, is in disagreeing with the priced range, not in hoping for the tail. And this model transfers. The same hockey stick, flipped and stacked, is every spread, every covered call, every position you'll ever build. Puts are the mirror image. Once you see options as payoff shapes priced against a distribution, the entire menu stops being a casino and starts being a toolkit. You're choosing a shape that matches a view, that's all trading options ever was. So next time a call tempts you because it could 10x, pull up the payoff. Find the strike, the break-even, the flat max loss floor, and the slope above. If you can't say what move you need and how it compares to what's priced in, you're not trading, you're buying a scratch ticket with extra steps. If breakdowns like this sharpen how you think, subscribe. Signal, not hype.